So now we can see on your P&L there's a huge difference, isn't there, between the income you've made and the cash that's come in, right? Huge difference. Only $1,500 worth of income was actually generated, but your business took in $21,200. Let's look at the expenses. A current expense for a current period, $500. Is that a P&L item? Yes, it is. Is that a cash flow item? If it's an expense, if it's cash, yes, it is. Bill paid for a previous period's expense. Is that a current P&L item? If you're doing your P&L correctly on the accrual basis? No, it isn't. Is it a cash flow item? Yes, it is. Loan interest accrued. What does that mean? That means you know you owe it, but you haven't paid it, right? That's loan interest accrued. You know that a month goes by, you owe another $100 on your loan, but you only pay, let's say, once a quarter. So you by accruing it, you say, I acknowledge it as an expense because I've incurred it in this period, but I'm not paying it yet. So yes, it is an expense, and no, it's not a cash flow item. Loan interest paid for a current period, that would be a profit and loss item, and it would hit the cash flow. Loan principal paid off. Everyone gets a little confused over this between principal and interest. Principal, the capital going in and out, does not affect your profit and loss. It's capital. So it doesn't affect your profit and loss, but yes, it is cash going out. You purchase a truck for cash, you pay $5,000. It's a capital item, it doesn't hit your profit and loss, but yes, it hits your cash flow. So here we can see $700 going out on profit and loss and $16,000 going out on cash flow. Do you see the radical differences? The radical differences between profit and loss and your cash flow. Cash flow, it's everything so long as it hits the cash column, right? Profit and loss is very, very exclusive. It's just the income and expense accounts. Okay, let's have a look at our next. By the way, folks, if you see something that looks odd and your business doesn't really agree with it, shout it out. Let's look at the next thing, and here's a great question. In general, can cash flow be close to your income and expense account, your profit and loss account? We know how different they are, but where would you get a situation where your cash flow is almost identical to your profit and loss account? Yes, sir.
You're working in a cash business, you're not carrying accounts, you're not borrowing money, you're not infusing your own capital into it.
Exactly. And you can say, if you didn't buy a truck, you didn't pay off any debt, you haven't borrowed money, you haven't taken any money out of the business, but all you've done is you've earned cash income and cash expense. If we look at that first one, I took a restaurant as an example. We would have you could have a net cash, a net profit of $5,000 and a net cash flow of $5,000. So here's an example where your business profit and loss and cash flow are pretty much the same. Would that happen in every business? Who is in a business where that absolutely doesn't happen? And what kind of businesses would those be? The ones where they're absolutely, the cash flow never looks like the income statement. Not even close.
Equipment, heavy asset businesses.
Okay, let's go a little further. What kind of equipment, heavy asset? I mean,
a contractor or manufacturing company that has large pieces of equipment that aren't part of an inventory that's resold.
And why would they be so different? What would make? I'm looking for one.
Purchasing or paying off or depleting the equipment without it affecting your.
Right. Okay. So exactly. So if you're buying equipment to rent, for example, you're going out there and paying $100,000 for equipment, and you're renting it out at $5,000 a month. In that particular month that you went out and paid that money for that equipment, what does your cash flow look like? Terrible. You've got $100,000 out and $1,000 or $5,000 in. What is the key consideration? Anyone think of what are the key considerations that show you? So it's actually down here. Let's have a look. Let's have a look at the next one, a home builder. Okay, I'm a home builder. I am going to take a year to build a house, and the following year I sell it. Okay, so in year one, I'm going to build this house. So I go and buy materials, and I go and buy, I get labor, and I start putting this house together. If I'm doing my accounting right, that is basically a little bit like inventory, exactly the same way as the greengrocer's got inventory on his shelf. The home builder, when he's building it, is that an expense? No, he's creating inventory, isn't he? He's going to sell it, but right now he's building its inventory. The only things he's going to have as actual expenses will be his telephone, his rent, he might have office expenses, and those are genuine running expenses. But the actual building of the house, that's inventory. That doesn't even show up on his profit and loss. So if we look at this home builder, he's got, through the year, he's got $40,000 of other expenses, telephone, rent, etc., etc. And so he's got he hasn't sold the house, so he's made no income. And he's got these other expenses, so he's showing negative $40,000. But his cash flow, what's he been doing all year? He's been buying equipment and paying for labor and building this home, right? So his cash flow, look at this first guy, the cash flow, the home builder, well, he spent $240,000 in his cash. So is there any tie-up between his cash and his profit and loss? Couldn't be further apart, right? What he's actually spent in cash and what he's actually done in profit and loss couldn't be further apart. What about the auto dealer? Now remember what an auto dealer does. An auto dealer, he's going to, especially the guys that sell on credit, right? They're going to buy equipment, they're going to buy, I beg your pardon, they're going to buy inventory, and then they're going to sell it. And let's say they sell it to you and they say, okay, look, here's your $5,000 car, just pay me $300 a month forever. Well, not forever, but longer. A few years. That guy's going to sell the car, he's going to have to show the sale, he's going to have to show the income, but does he get that money straight away? No, he doesn't. He's paid for the car's gone out the door, and he's now got to wait forever and ever to get his money. So is his cash flow going to be anywhere close to his profit and loss? Nowhere close. Nowhere close. Okay, just so you can see that depending on the kind of business you got, that's how it's going to affect your income statement and your cash flow. Okay, the next question is, so we understand there's this thing called cash flow. We understand that it's not profit, it's not income, it's not profit, it's cash flow. Why would this be crucial to knowing about the cash flow in our business? Why is this crucial to every single business?
It's got to be part of any long-range planning.
What about short range?
You have to have enough money to pay your taxes and your employees.
If you went to your employees at the end of week one and said, guys, you know, we're very profitable. This is a tremendously profitable business, but unfortunately I've got no cash to pay you. How long are they going to stay? About to the end of that sentence, right? So we need to know, very critical, because these are the things we need. We need working capital. We've got to pay for materials, payroll, overhead on a regular basis. We need money for capital purchases. I'm a builder and I'm about to start my third house and I've only got one truck and I need to go and buy another. Well, where am I going to get that from? That's a big capital purchase. I need to pay off loans. You can be going along very nicely in a very profitable business and you get this little very thin envelope from the Coastal Bank that says, you know, you've been a great customer, but unfortunately if you read the small print on your loan document, it says that the money's due today, all of it, by 12 o'clock. No, I'm sure you don't. So, you know, you can have a nice balloon on a loan that's due, and then you can need dividends. You know, you have to live as well. You can have a highly profitable business, but you need to pay yourself. And then there's miscellaneous other. This is how we measure it. Going across to the, I don't know if any of you were here in our I think it was either the last session or the session before, where we said you can't control something unless you measure it. Remember that? Isn't that a great saying? You can't control something unless you measure it. You have to know where you are in order to be able to control where you're going. You have to know where we are with cash. Believe it or not, it's actually, it sounds a little bit difficult or complicated, but believe it or not, it's actually not that hard to figure out your historical cash flow and your future cash flow. But this is how you figure out your historical cash flow. Of course, how many of us are interested in our historical cash flow? Probably nobody. You know, we're here now, thank goodness, you know, we paid our labor. You know, no one's banging on the door, hallelujah, you know, move on. But if we are interested in exactly what is happening to our cash, where it came from, or if you're like me and you're sitting down at the end of the year with the guy that asked that very first question, I made $125,000. Yes? Where is it? This will answer that. This will answer exactly that question. If you have a look here, all we've done is we've taken the last period's balance sheet. Now, of course, you have to have good accounts. That's why you come to Hancock Askew, so we can give you good accounts, so you can have a balance sheet. If you haven't got a balance sheet, you know, we know it. You have to have a good balance sheet for 2 separate years. So if you've got a previous year balance sheet and a current year balance sheet. So let's say the last period is the end of 11, and this period is the end of 12. You've got a year you're looking at. If my fixed assets for 2011 is 120,000, and my fixed assets for 2012 have grown to 130,000, would that be a net cash inflow or a net cash outflow from my business?
No.
Did you say outflow? Right? You're right. It's a net cash outflow. Why? Because imagine if I had trucks. Trucks are always easy to understand. I had 4 trucks at the end of 11. I had to buy 1 more truck to get me through to the end of 12. So I had 4 trucks. I had to go and buy another for 10,000. You buy a truck for 10,000. So what's happened to my cash in that year? Shrunk. Right? It's 10,000 has gone out. So you'll see, for example, that your fixed assets have gone out. Now, what about current assets? Remember, we spoke about your accounts receivable. 2011 it was 50,000. 2012 it's 60,000. What's that done to your cash flow? What's that done?
It had to be funded from someplace.
It's gone, exactly. It's a net cash outflow of how much? From 50 to 60, a net cash outflow of 10,000. What's the general rule we're picking up here? If your assets, go and look at your assets at the end of 2011, then look at your assets at the end of 2012. Again, we're assuming you have a balance sheet. And you see that your assets have grown. We take cash out of the equation because your cash is your reconciling number at the bottom. You take the cash out of all your assets because cash is an asset, but you take the cash out of your assets, you look at 11, you look at 12, and there's been a net increase in assets. What has that done? How was that? Was that a cash in or a cash out? It was a cash out.